Hello and welcome to the session in which we would look at ratio analysis, which is part of Chapter 3, working with financial statements. Now what I decided to do is to cover all the ratios in this one session. So I'm just going to scroll down, show you all the ratios I'm going to be covering in this session. So if you want to fast forward, slow me down, or put me on a speed, it doesn't matter. Those are the common financial ratios I'm going to go over in this session. So just keep that in mind. I'm going to go over them in this order: short-term solvency, long-term solvency, asset management, profitability ratios, then market value ratios. So if you want looking for something specific, that's the order, so you can fast forward. But first we need to discuss what is a ratio, how is the ratio used, so on and so forth, before we actually look at the ratio. And the ratio in its simplest form is what? Ratio is X over Y. Basically taking one number, dividing it by another number. So taking one number from a financial statement, and that financial statement could be the balance sheet, could be the income statement, and dividing it by another number that could be the balance sheet, could be the income statement, or that number could be, as we're going to see, the price of the stock. Okay, so basically taking one number, dividing it by another number. Usually you are using financial statement numbers, but sometimes you may use something other than financial statements. So what is the ratio analysis? Remember, once you take two numbers and you divide them by each other, you're going to get a ratio. Ratio basically is going to be 0.5, 0.7, 1.68, some number. And that number, in a sense, it's a common size. So you could compare two companies to find out the ratios between them. So this way, you can compare the companies, although they might be of different sizes. So let's go ahead and dive into the introduction of ratios that will look at different group of ratios together. So it's worth just reading and highlighting just to make sure we cover all our bases. So another way of avoiding the problems involved in comparing companies of different sizes is to calculate financial ratios. Such ratios are ways of comparing and investigating the relationship between two different pieces of financial information. Using ratios eliminate the size problem because the size is effectively divided out or kind of canceled out. Then we are left with a percentage, multiple, or time period. So it helps us compare two companies of different sizes. There is a problem in discussing financial ratios because a ratio is simply one number divided by another, and because there are many accounting numbers out there, we could examine a huge number of possible ratios. Everybody has a favorite ratio. We will restrict ourselves to a representative sampling. So what we're seeing here is the most common used ratios. In this section, we would only want to introduce you to some commonly used financial ratios. Those are not necessarily the one we think are the best. In fact, some of them may strike you as illogical or not so useful as some alternatives. So remember, ratios, it depends on the industry, depends on the company, depends on your need, depends on many things. But we have to look at a sample representative of all the ratios. So don't be concerned. If they do, don't be concerned. As a financial analyst, you could always decide how and which ratios to compute and which ratio is relevant to you. So this is just a sample. What we need to worry about is what? Let's see. What we need to worry about is the fact that different people and different sources seldom compute this ratio in exactly the same way. And this leads to much confusion. So we're going to see as we do the ratios here, we're going to say you could do it this way, and some analysts may do it in another way because it makes more sense. They think it makes more sense. The specific definition we use here may or may not be the same ones as you have seen or will see elsewhere. Even between courses and between publishers, they may differ. If you were ever using ratios as a tool for analysis, you should always be careful to document how you calculated each one. Because if someone else is looking at your ratio and they want to compare your ratio to theirs, if they're not calculated the same way, they might be called the same way, but if they're not calculated the same way, then they're not comparable. Okay? We will defer much of our discussion of how ratios are used and some problems that will come up with using until later on in the chapter. So for now, for each of the ratios we discuss, we consider several questions. The first thing, mathematically, how is it computed? What is it intended to measure and why we might be interested? So what is this ratio tells us? What is the unit of measurement? Is it percentage? Is it multiple? What is it? What might be a high or a low level tells us if it's too high, too low. How might such value be misleading? And how could this measure be improved? How could we improve this ratio? Is it improving the numerator, denominator, improving the numerator and the denominator at the same time? Like, what do we need to do? Okay, so we're going to look at the different ratios, and we're going to group them into 5 groups. 1, short-term solvency. I'm going to cover them in this order. 2, long-term solvency or financial ratios. 3, asset management or turnover ratio. 4, profitability ratios. 5, market value ratios. So I'm going to break them into this section. The first, we're going to look at short-term solvency or liquidity ratio. And first, we're going to kind of introduce it. What does it tell us? As the name suggests, it's short-term solvency. Well, are intended to provide information about firm's liquidity. So we're concerned in the short term if the company has enough liquid asset to cover itself, are sometimes called liquidity measures. The primary concern is the firm's ability to pay its bill over the short run without stress, without undue stress. Consequently, these ratios focus on current assets and current liabilities, of course, because if you know the definition of current assets and current liabilities are things that you have to pay within the next 12 months. Current assets are assets that you can use to pay off your current liabilities in the next 12 months. So most of the liquidity ratios will be around current assets and current liabilities. For obvious reasons, liquidity ratios are particularly interesting to short-term creditors. So if somebody wants to lend you money for a short period of time, they'll be interested in those type of ratios because their main concern is, are you going to pay them in the next year if they give you the money now? If not, then it's a problem. Okay? Now, one advantage of looking at current assets and current liabilities is that their book value and their market value are most likely the same. What does that mean? It means if current assets are cash, receivable, short-term investments, inventory. Usually, their book value and their market value, with the exception of inventory, which is the market value of inventory is higher, is if it's not the same, it's better. So that's why they're really good. And also your short-term debt is really representative of your short-term debt, of the market value of your short-term debt. Okay? Often, not always, these assets and liabilities just don't live long enough for the two to get seriously out of step. So that's why, because they're short term, so that's why they don't lose value. Okay. On the other hand, like any type of near cash, current assets and liabilities can or do change rapidly, so today's amount may not be reliable to guide in the future. Okay. Of course, they can change, but they're not likely to change. So let's take a look at the first ratio, and this is usually the first ratio that you learn in accounting. And that's the current ratio. That's the current ratio. So let's look at the current ratio. Current ratio, one of the best known and most widely used current ratio. And this is the first ratio you learn in financial accounting. It's taking current assets divided by current liabilities. So for Prufrock, current assets were 708, current liabilities were 540. So the current ratio is 1.3 times. Now, we need to understand what does 1.31 means. Well, let's assume we had a current assets of 100, current liabilities of 100. 100 divided by 100 equal to 1. What does 1 mean? It means it's 1 to 1. It means for every dollar in liabilities, we have $1 in asset. Let's assume we had 200 in assets and 100 in liabilities. Then the ratio is 2. It's 2 to 1. 2 to 1 means for every dollar in liabilities, we have $2 in assets. 1.31 means for every dollar in liabilities, for every $1 in liabilities, we have $1.31 in current asset. Is this good? Is this bad? It all depends. Historically, they would say 2 is good for current liabilities. Less than 1 is bad. But again, ratios, they have to be taken within a specific context. Okay? Because current assets and current liabilities and principal converted to cash over the following 12 months, the current ratio measured the short-term liquidity. So we would say that Prufrock has 1.31 in current assets for every dollar in current liabilities. So we could say that Prufrock has its current liabilities covered 1.31 times. So we can cover their liabilities more than once. To creditors, to people who's going to lend you money, short-term creditors such as a supplier, they want this number to be as high as possible. Say they want you to have more current assets than current liabilities. The higher the better. To the firm, so if you're the company, a high current ratio indicates liquidity, but it also may indicate inefficiency use of cash and other short-term assets. So it's good for you, it gives you protection, but cash doesn't give you a lot of return. In the absence of some extraordinary circumstances, we would expect to see a current ratio of at least 1 because we need to have more current assets than current liabilities. Otherwise, if we have more liabilities than current assets, then we have a negative working capital. Okay? It doesn't mean that companies are bad if they have negative working capital. Some companies do have negative working capital. Okay? The current ratio, like any ratio, is affected by various types of transactions. So remember, the current ratios, they could be affected. For example, suppose the firm borrows over the long run to raise money, therefore they don't use short-term. The short-term would be increase in cash from the proceeds issued from the long-term debt. So current liabilities would not be affected. So depending on how the company finances itself, it can influence the ratios. Finally, note that apparently low current ratio may not be a bad sign for a company with large reserve of untapped borrowing power. So just because you have a low current ratio, it doesn't mean you're in a bad position. Why? Because you can go to the bank at any time and have a large line of credit. Okay? So we're going to move from the current ratio to another ratio, which is similar but not the same, and it's called the asset test or the quick ratio. So why do I say similar? Let's see why similar. Okay, and hopefully you can see why it's similar. It's similar because if we look at the denominator and the ratio, the denominator is the same. What's the only difference between the two is the numerator. And what's the difference in the numerator? We take the inventory out. We take the inventory out of current assets. Why do we do this? Let's explain the process of this. Inventory is often the least liquid asset. It's also one for which the book value are least reliable as measure of market value because of the quality of the inventory is not considered. Some inventory may later turn to be damaged or obsolete or lost. So what we do is we say, let's take inventory out of the picture from the numerator. How good are we in meeting our short-term obligation? This is what we're saying in the asset test ratio, or sometimes we call it quick ratio. Why quick ratio? Because we assume that cash, account receivable, and investments, in another book, that's the only 3 assets they use. They use those 3 assets in the numerator, not current assets minus inventory. We call those quick assets. And quick asset means what? Quick assets means they can be easily converted to cash quickly. That's why we put them in the numerator. More to the point, large inventory are often a sign of short-term trouble. Also, if you have too much inventory, that's definitely a sign of trouble. The firm may be overestimated sales and overbought or overproduced as a result. In this case, the firm may have a substantial portion of its liquidity tied up in slow-moving inventory. And how do you move your inventory? You lower the price, which is not good. It's going to affect your profit. To further evaluate liquidity, the quick or asset test ratio is computed like the current ratio, except we omit inventory. Again, as I told you in other textbook, in the numerator you only have cash, receivable, and short-term investments. Short-term investments, not inventory. Short-term investments. Okay. Notice, using cash to buy inventory does not affect the current ratio, but it does reduce the quick ratio. Again, the idea is that inventory is relatively illiquid compared to cash. So, if we look at ProofRock, the company we are working with, if we take current asset minus their inventory for 2015 divided by current liabilities, we get 0.53. What does that mean? It means taking inventory out, we can only cover out for every dollar in liabilities, we only have 53 cents to cover. So we have half of the assets to cover the liabilities if we take the inventory out. The quick ratios tells us a different story than the current ratio because inventory accounts for more than half than the current asset. To exaggerate the point, if this inventory considered, let's say, unsold nuclear power plant, then this would be a cause for concern. Because let's assume you cannot sell your inventory, then you're in real trouble. Okay? To give an example of current versus quick ratio, based on a recent financial statement, Walmart and Manpower Inc. had a current ratio of 0.3, Walmart, and 0.14 respectively. However, Manpower carries no inventory to speak of, whereas Walmart current assets are virtually all inventory. Now bear in mind, Walmart and Manpower, they're not even comparable companies. I don't know why they would give you those ratios. I guess the reason they want to show you this two ratios to remind you that ratios, you have to take them into a context. Okay. As a result, Walmart quick ratio is 0.22, whereas manpower is 0.14, which is almost the same because you did not take anything out of the numerator for manpower because they don't have any inventory. Okay, so this is the second ratio. We're going to look at other liquidity ratios, which is they cover the same thing as the first two ratios, but they're like we can discuss them very quickly. One of them is called the cash ratio, and I believe the cash ratio is the best indicator for short-term liquidity because it's taking cash, so it's removing inventory, removing account receivable, removing everything except keeping cash in the numerator, but the denominator is still the same. So let's take a look at it and let's see how it's being calculated. So if we look at it, it is for 2015, it's 0.18 if we take cash divided by current liabilities. What does that mean? It means for every dollar in liabilities, we only have 18 pennies in cash to pay it off. Okay. Okay, let's move to another ratio, and that's net working capital to total asset. Another way we can look at liquidity is look at net working capital. And what's net working capital? Hopefully you remember this. It's current assets minus current liabilities. So we'll take, net working capital divided by total asset, and that's equal to 4.7%. So we have net current asset of 4.7% overall. Now, the higher this number, the better off we are because we have more net working capital relative to total asset. Okay? Now, finally, imagine that Prufrock was facing a strike and cash flow began to dry up. How long would this business keep running? One answer is given by the interval measure. So what's the interval measure? Interval measure is taking current assets divided by the average daily operating cost. So, total cost for the year, excluding depreciation and interest, were $13.44, which is the average daily cost. $13.44 divided by 365, which is taking the expenses excluding depreciation and interest. So per day, it's 3.68. The interval measure is thus 708 divided by, which is our current assets, divided by 3.68. So we have 192 days basically of cushion that if something happened, we can use our current assets, liquidating our current assets to keep on working. Okay, based on this, Prufrock could hang on for 6 months or so 192 days. This interval measure or something similar is also useful for newly founded or startup companies that often have little in the way of revenue. So they want to know what would happen in a worst case situation. For such companies, the interval measure indicates how long a company can operate until it needs another round of financing. Okay, for example, if you're Twitter or Tesla, because they're new companies, they bring this measurement all the time. For example, every 6 months they may need a new round of financing because they don't have a lot of internally generated financing, so they need an outside source. So the average daily operating cost is often called the burn rate, how fast they are burning cash, meaning the rate of which cash is being burned in the race to become profitable. Because at the beginning of the life of the company, at the beginning, you don't make a profit. Up to a point, then you're going to be making a profit. For example, took Amazon almost a decade, a little bit less than a decade, to start making a profit. So all this time they were burning cash. So this is another, those are all short-term liquidity measurement, cash ratio, and they all complement each other. So basically we are done with the first group of ratios, which is the liquidity ratios. Liquidity ratios right here. We're done with the short-term or liquidity ratio. The next thing we look at is the second group is long-term or solvency ratios. So let's take a look at the solvency ratios. They basically, to a degree, they're covering the same thing as the short-term, but from a long-term perspective. So solvency ratio, we're gonna look at what they are first, and we're gonna look by looking at total debt ratio. Let me just So long-term solvency. Now we're looking at the company not from a short-term perspective, but from a long-term perspective. So long-term solvency ratios are intended to address the firm's long-term ability to pay its obligation, or more generally, its financial leverage. These are called financial leverage ratios or just leverage ratios. So those are a bunch of ratios that's going to tell us how is the company financing itself. Because when you finance yourself, you don't want to rely on short-term, you want to rely on long-term, because short-term, you have to pay them every year. You want to rely on long-term financing that's going to give you more time to get you up and running. Then you can pay off your debt. The first ratio we look at is the total debt ratio. The total debt ratio takes into account all debt of all maturities to all creditors. It can be defined in several ways. The easiest way is this. The total debt ratio equal to total assets minus total equity, which is assets minus equity equal to liabilities. So they do this, and it ends up to be, in the numerator, you have liabilities divided by total asset. And this is going to give us 0.28. What does 0.28 means if we have a debt ratio? An analyst might say that ProofRock uses 28% debt. Whether this is high or low, it makes any difference depending on whether the capital structure of the company matter. Okay, a subject that's going to be discussing in chapter 6. So is 0.28 a lot or not a lot of a high debt ratio or not a high debt ratio? It depends on your industry, which we'll see later on. Okay, but the higher this ratio, the higher is the leverage. Leverage means what? Leverage means the higher you are relying on debt, and the higher your leverage, the higher the risk. And it all depends on your industry. For example, the airline industry will have a high leverage. A retail industry will have low debt ratio. Okay, so ProofRock has 28 cents in debt for every dollar in asset. So basically, if we look at their balance sheet from $1 perspective, they have $1 in asset, 0.28 is coming from debt. Let's make it $100. If they have $100 in assets, $28 is coming from debt. Obviously, then what? 72 is coming from equity. 72. So this is the equity, and this is the debt. This is what we're saying. Okay. With this in mind, we can define two useful variations on the total debt ratio: the debt to equity and the equity multiplier. Notice, because this is assets, debt or liabilities, then equity. So we could just basically manipulate those figures. So we could also calculate debt to equity. And what's debt to equity? It's taken the debt, 0.28, divided it by equity, 0.72, or 28 divided by 72, which is 0.38. So again, here is showing us the capital structure of the company. Or we can calculate something called equity multiplier. Equity multiplier is taken total asset, which is 100 or 1, divided by 0.72 or 72, which will give us 1.38. So basically, if we take 1 plus the debt ratio, 1 plus the debt ratio, I'm sorry, debt to equity, 1 plus debt to equity, it's going to equal to the equity multiplier. The fact that the equity multiplier is 1 plus the debt to equity ratio is not a coincidence. Let's kind of show it. Total assets divided by total equity is 1 divided by 7.72, okay, which is if you really think about it, total asset is total equity plus total debt divided by total equity. So it's 1. This is why it says 1 plus debt to equity ratio. So if you manipulate the formula, that's why it's 1.38. So basically, those are different things, a different calculation of saying the same thing. Okay? The thing to notice here is that giving any of these three ratios, you can immediately calculate the other two, so they all say exactly the same thing. What does that mean? What can we say? The company is mostly relying on equity rather than debt. 72% of their assets is tied up in equity, not in debt. Okay? So just we need to kind of expand on this a little bit. Expand on the liquidity ratios. Frequently, financial analysts are more concerned with the firm long-term debt. Why? Because short-term debt will constantly be changing. If you have an accounts payable, if you have accrued liabilities, they constantly change depending on your operation. Also, a firm's accounts payable may reflect trade practice more than debt management policy. Your accounts payable depending on your creditors. What's your relationship with your creditors, not how you borrow money. For those reasons, many what they use, they don't use total liabilities, they only use long-term debt in the numerator. So they take the long-term debt divided by the long-term debt plus equity to find out how much of your assets is financed through debt. Okay, so now what we do is we'll take long-term debt divided by long-term debt plus total equity, and this is called long-term debt ratio. Okay, that's going to give us 0.15. It means 15 for every dollar, you're only relying on $15 on long-term debt. Remember, the total debt was what? The total debt was 0.28. Okay, but the true debt, the long-term debt, is only 0.15. Okay, the 3,048 in the total long-term and equity section is also called the total capitalization. Capitalization means how you are financing your company. The financial manager will frequently focus on this quantity rather than total assets. So they would look at your total long-term debt plus your equity. They factor out the short-term debt. Also, to complicate matters, different people in different books mean different things by the term debt ratio. Some mean a ratio of total debt, some mean a ratio of long-term debt only. And unfortunately, a substantial number are simply vague about which one they mean. It doesn't matter. All what matter, if you're really using it in the real world, basically if you're using only the long-term debt, keep using long-term debt. So this way, your ratios are comparable from year to year, from period to period. If your competitor is using long-term debt, you need to use your long-term debt. If you're comparing to someone who's using total debt, then you would use total debt. This is a source of confusion, so we choose to give you two separate names to the two measures. The same problem comes up discussing debt to equity ratio. Financial analysts frequently calculate this ratio using only long-term debt. Just keep in mind, as long as you are consistent, it doesn't matter how you calculate those ratios, because you want to have consistency. Another ratio we can use to measure the solvency of the company, which is the long-term ability to survive, is how well we can cover our interests. Another common measure of solvency is something called times interest earned, or TIE. Once again, there are several possible definitions, but we will stick to the most traditional. Indeed, there's also a few definitions for this. But for our purposes, to calculate times interest earned, we're going to take earnings before interest and taxes divided by interest. And for proof rock, if we'll take EBIT from the income statement divided by interest, it's going to give us, I'm going to say 5 times. What does 5 times mean? It means you have earnings 4.9, that's why I said 5. Your earnings can cover 5 times your interest. Now, the higher this number, the higher this ratio, the better off you are. It means the more coverage you have for your interest. As the name suggests, this ratio measures how well a company has its interest obligation covered, and it's often called interest coverage ratio. For proof rock, it's 4.9. The higher, the better. The higher, the better. Another ratio we can use, which is very similar to the times interest earned, but now what we're going to be using, not earnings, we're going to be using mostly kind of figuring out from a cash perspective, called the cash coverage. So, a problem with times interest earned is that it's based on EBIT, okay, which is not really a measure of cash available to pay interest. The reason is we deduct depreciation before we get to EBIT. And remember, depreciation is a non-cash expense, okay, because interest is definitely a cash. One way to define the cash coverage ratio is to take EBIT, then add depreciation, then divide it by the interest. Now, if we take EBIT plus depreciation, obviously what's going to happen to our interest coverage? It's going to go up. So some uses this formula, the other uses the just EBIT divided by interest. Okay? So it all depends. For example, some companies may not have large depreciation, so depreciation is not an issue. And some companies might have a large depreciation amount, then depreciation is an issue when you're calculating your cash coverage. Okay, the numerator here is EBIT plus depreciation, is often abbreviated as EBIT-TD, which is earnings before interest, taxes, and depreciation. EBIT-D. It's a basic measure of the firm's ability to generate cash from operation. It's frequently used as a measure of cash flow available to meet financial obligation. Okay. There's also there's a variation of the EBIT-D. Sometimes what you do if you have amortization, and what is amortization? Amortization is similar to depreciation, but it's for intangible asset. You add amortization because amortization also is not a cash expense, just like depreciation. So those are cash coverage times interest earned, a long-term debt ratio, debt to equity ratio. Those are long-term solvency ratios. So those are the solvency ratios. This is how we measure how well a company is doing from a long-term perspective. The next group of ratios we're going to cover right now is called asset management or turnover measures. So how well company is utilizing their asset, how well a company is utilizing their asset. And specifically, we're going to be looking at inventory and receivables. So let's take a look at an overall introduction about asset management or turnover. Okay. Now we look at a bunch of ratios that deals with the companies, how well they are efficiently running their company. The measure in this section are sometimes called asset utilization ratios. So you may know them by asset utilization. The specific ratios we discuss can all be interpreted as measures of turnover. What they are intended to describe is how effectively or intensively a firm uses its asset to generate sales. Okay, we first look at two important current assets, inventory and receivable. So now we're going to look at how well a company managing their inventory, how well a company is managing their receivable. Okay. During the year, ProofRock has a cost of goods sold of $1.3 billion. Inventory at year end was $422. With these numbers, we can calculate something called inventory turnover, with the cost of goods sold divided by inventory. Now, in other textbook, you don't divide it by ending inventory, you divide it by average inventory. But here they say ending inventory. They're assuming that the beginning and the ending inventory are the same. But it doesn't matter. I just want to make you aware of that. What we get is 3.2. What does 3.2 means? It means during the year, the company sold their inventory once, twice, 3.2 times. They sold their inventory once, twice, 3.2 times. Obviously, you want to sell the inventory as many times as possible. How could you improve your inventory turnover? One of two things. You can reduce your inventory. So if let's assume you were holding inventory, half of this, 211 of inventory, and you calculate the ratio, then your turnover is 6.4. So you're carrying less inventory. Okay? Or you can reduce your cost of goods. So you can increase cost of goods sold. You can increase cost of goods sold. For example, if your cost of goods sold were 2.6, if it was double, and your inventory is the same, then this will be 6.4. So you either increase this or reduce this. Okay. The higher this ratio, the more efficiently we are managing inventory. So the more you can turn over your inventory, the better off you are. Now, another related ratio to this ratio is how many days your inventory is sitting in your store. Okay, this is called days sales and inventory. And to calculate days sales and inventory, all what you have to do is take 365, the number of days of the year, divided by the inventory turnover. So if you take 365 divided by 3.2, it's taken you 115 days to sell your inventory. So in a year, so for every 115 days, you sell your inventory. Every 115 days, you sell your inventory. Okay, approximately 115 days. Now, some inventory may sit on the shelves longer, some inventory may sit on the shelf shorter. Now, obviously, you should know that it all depends on the business that you are in. If you are selling perishable goods, your inventory should turn over very fast. If you're selling items that can last on the shelves, then your inventory will can afford to sit on the shelf longer. Okay? To give an example, in December 2013, the US automobile industry as a whole had 54-day supply of cars, less than 60 days supply considered normal. These figures mean that at the current rate of sales, it will take around 54 days to deplete the available supply. Okay, of course, this is a significant variation across models. Of course, some models may sit longer, some models may stay shorter in the parking lot. With newer, hotter selling models, there's a shorter supply and vice versa. Okay, so also in 2013, Nissan Leaf had only 13 days of sales compared to 232 to the Cadillac. So the Nissan Leaf, they were selling very quickly. Okay, it makes more sense to use the average inventory in calculating the turnover, which what I said earlier. Okay, it depends on the purpose of the calculation. If you're interested in how long it will take us to sell our current inventory, then using ending is probably better. Average is better. Okay, in many of the ratios we discuss in this chapter, average figures could just as well be used. Of course, so we're not going to repeat this. Again, it depends on whether we are worried about the past, in which case average are appropriate. We should always be worried about the past, because what happened, the companies, to manipulate the ratios, they can increase their inventory or reduce their inventory toward the end. So if you really want to find the proper ratio, take the beginning and the end and find the average. This way, companies cannot easily manipulate their ratios. Okay, also using ending figures is common in reporting industry averages. Sometimes that's the case, often it's not. So for comparison purposes, ending figures should be used in such cases. In any event, using ending is definitely less work. Yes, of course, but in accounting we use the beginning and the ending. So we will continue using them, because for our purposes, we're just getting a taste of the ratios. Okay? The next ratio we're going to look at is very similar to inventory turnover. It's receivable turnover. And what's receivable turnover? How many times you are turning over your receivable. So basically, how many times you sell on account, collect, sell on account, collect, sell on account, collect, so on and so forth. So you want this to be as high as possible, because you want to sell, receive your money, sell, receive your money. So our inventory turnover gives us some indication how fast we can sell the product. Now we look at how fast we can collect on those sales. This is what the receivable turnover is all about. To calculate the receivable turnover, we're going to take sales. And here there's a variation. If you use sales on credit, but we're going to use sales divided by account receivable. Again, we could use the average, but I'm going to stop talking about this. So we're going to take sales divided by the receivable. And this tells us you turn over your inventory 12 times 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 times a year. Okay? Loosely speaking, ProofRock collected its outstanding account and reloaned money 12.3 times during the year. Again, what we can do, we can find days sales and receivable, how long it's taken us to collect the money. Basically taking 365 days in a year divided by the receivable turnover. And if you're turning over your inventory 12 times, around 12 times, it means every 30 days you collect your receivable. And that's to a great degree industry practice. You want this number to be low. You want this number to be low. So you want to collect earlier than 30 days. You want this number to be 20. And for this number to be 20, you need to increase your receivable turnover. Okay? And how do you increase your receivable turnover? Have less receivable and or have more sales. This is how you could improve it. All right. So this is the receivable turnover. Another ratio we can use is called the asset turnover ratio. Now we're going to look at not current assets. We're going to look at the overall assets. So we looked at current assets, which specifically we look at inventory and receivable, which they're both current. Now we're going to look at total asset ratios. Okay? Moving away from specific accounts like inventory and receivable, now we look at the big picture. For example, net working capital turnover. What is that? That's taking sales divided by net working capital. So if we take for ProofRock, it's 13.8. This ratio measures how much work we get out of our working capital. What does that mean? It means how well you are using your working capital. The more sales you have, the better off you are. And the more sales and the less working capital. So you want to have less working capital, more sales, or more sales or less working capital. Okay? Once again, assuming we are not missing out on sales, a high value is preferred. Missing out on sales means we're not losing money on every sale. Why? Because the more we can utilize our assets, the less resources we have to commit to produce those sales. Another ratio, very similar, is called fixed asset turnover, taking sales, dividing it by fixed asset. Here we are, sales is 2.3, fixed asset 2.8. The ratio is 0.8. What does that mean? It means for every dollar in fixed asset, we are generating 80 pennies in sales. So for every $100, we are generating $80 in sales. Is this good? Is this bad? It all depends on your industry. For example, Walmart, they need to generate, for every dollar, they need to generate 250% in sales because they need to turn over their sales, because that's what they do. They make a small profit, so they rely on sales turnover. For a jewelry store, their turnover is very low. They don't generate a lot of sales per fixed asset. So it all depends on the industry. Our final asset management ratio is total asset turnover. Basically the same thing. Taking sales now and dividing it by total asset rather than just fixed asset. And it's telling you the same thing. It's how much from every dollar in assets you are generating sales. Here you are generating 64 pennies for every dollar in asset. That's all what it is. Okay? To give an example of fixed and total asset turnover based on recent financial statements, Southwest Airlines, which is an airline industry, had a total asset turnover of 0.88 compared to IBM 1.5. Once again, IBM and Southwest Airlines, they are not comparable. You want to compare Southwest Airlines maybe to Delta. Okay? However, the much higher investment in fixed asset in an airline is reflected in Southwest fixed asset turnover of 1.71. So their fixed asset turnover is 1.71 compared to IBM 4.41. So here showing you that, actually they're showing you that they're not comparable. I don't know why they do this. They should have showed, for comparability purposes, you should show something that's comparable, but here they're showing you that they're not comparable because they're in two different industries. Okay? Suppose you find a particular company that generates 40 cents in sales for every dollar in total asset. How often does this company turn over its total asset? Well, the total asset turnover here is 0.4 times per year. It takes 1 divided by 0.4 equal to 2.5 years to turn the total asset over completely. That's all what it is. You take 1 divided by the asset turnover. It tells you how many years to turn over the asset completely. Okay, so we're done with the turnover. Now we're going to be looking at another set of ratios, and those are the profitability ratios. And as the profitability word means, we're going to be measuring company from a profit perspective. Okay, the 3 measures we discuss in this section are probably the best known and the most widely used of all financial ratios. In one form or another, they're intended to measure how effectively a firm uses its asset and manages its operation. The focus in this group is on the bottom line, which is, what's the bottom line? Net income. All right, the first ratio we're going to look at is profit margin. Profit margin. Companies pay a great deal of attention to the profit margin. How is the profit margin calculated? It's taking net income divided by sales. If we look at the income statement, this is the bottom figure on the income statement, and this is the top figure. This is called the top number, the top line. Sales is the top line because it's the first number. So basically taking the bottom figure, dividing it by the top figure. If those were 10 and 100, the answer will be 10%. 10 divided by 100 is 10%. How do we interpret this figure? It means for every $100 in sales, we keep $10. So for every 100, we keep $10 in profit. Obviously, you want this number to be as high, this percentage to be as high as possible. Okay, this tells us 15.7 that proof rock in an accounting sense generally generate little less than 16% for every dollar in sales. All other things equal, a relative high profit margin is obviously desirable. The situation corresponds to low expense ratio relative to sales. So if you have a high profit margin, it means your sales are lower, because if you're keeping it in profit, you're not spending it in expenses. However, we hasten to add that other things are equal. Why? Because if this number is high, then you may not be selling a lot because you're making a lot of profit. So if you want to sell a lot, this number might be low. You want to accept less profit. So you have to be careful. For example, lowering our sales price will usually increase unit volume, but will normally cause profit to shrink. So if you want to sell more, this number is going to go down. If you want this number to stay up, yeah, we can have it up, but you're going to sell much, much less. So you have to be very careful. So total profit may go up or down. So the fact that margins are smaller isn't necessarily bad. So you have to look at the whole picture. Once again, no one figure will make sense in ratios. They all have to be taken into a specific context. After all, it isn't possible that, as the saying goes, our prices are so low that we lose money on everything we sell, but we make it up in volume. So if you're selling at a loss, you're going to sell a lot, but you're going to be selling at a loss. So you're better off not selling. Another ratio that's profitability ratio, another two ratios, is return on asset and return on equity. And what is return on asset? When we hear the word return in a ratio, it means net income. When we hear the word on, it means divide. So net income divided by asset. This is a measure of profit per dollar of assets. So how much profit are we generating for every dollar in assets? If our net income is 100 and our total asset is 1,000, it's the situation here, it's 10%. It means for every dollar in asset, we are generating 10 pennies in profit, 10%, 10 pennies. Here, same thing with this company. Obviously, the higher the better. How could you improve this? Reduce your asset and or increase your net income. Another measure that's similar to return on asset, which is return on equity, ROE, is a measure how stockholders fare during the year. Now, this measure focuses on the stockholders. Because benefiting shareholders is the goal, ROE is in the accounting sense the true bottom line measure performance. ROE is usually, notice they say usually because in different books they may adjust the numerator, is net income divided by equity. And for ProofRock, net income is $363, equity is $25.91. So return on asset, a return on equity for the shareholders is 14%. What does that mean? It means for every dollar in equity the shareholders invested, they expect to generate 14 cents in accounting terms. Okay? Because ROA, which is return on asset, and ROE are such commonly cited numbers, we stress that it's important to remember these are accounting rate of return. For this reasons, these measures should be properly called return on book assets and return on book equity. Because we're using accounting figures, and accounting figures, we say those are the book figures. In fact, ROE, sometimes called return on net worth, whatever it's called, it would be inappropriate to compare the result to, for example, an interest rate observed in the financial market. Of course, we cannot compare something that's in the financial market based on the market value to something on the books. We will have more to say about this in future chapter. We'll talk about this. The fact that if ROE, return on equity, exceeds ROA, reflect that ProofRock uses financial leverage. And we'll examine this relationship more in detail shortly. We'll talk about this shortly. If its ROE exceeds more than ROA. Okay? The next set of measure we're going to look at is, again, another set of ratio is, I believe those are the last one. Yes. The last set of ratio we're going to look at is market value measures. Market value measures. And those are the most interesting ratios. Market value. So let's look at them. So our final group is based in part on information not necessarily contained in the financial statement. Now we're going to be using numbers other than the financial statements. The market price per share of stock. We're going to look at the actual share of stock. Obviously, these measures can be calculated directly for publicly traded companies. Of course, now we're dealing with publicly traded companies. Let's assume ProofRock has 33 million shares outstanding and the stock sold for $88 per share at the end of the year. So we're making two assumptions. We have 33 million shares outstanding. It means there are 33 million shares in the hands of the public, and the stock price is worth $88 per share. If we recall, ProofRock net income was 363 million. Now we can calculate what we learned in the prior chapter, EPS, which is earnings per share. We're going to take net income, 363 million, divided by shares outstanding, 33 million. And from an accounting perspective, each shareholder earns $11. Earnings per share is $11. Now, as we talked about in the prior session, the higher this number, the better off we are. Now, and this number is going to help us calculate something even more important and more interesting. That's PE, or the price earning ratio. So from earnings per share, we can calculate the PE, the price earning ratio of a company. And how to calculate the PE ratio? As the ratio suggests, PE, price divided by earning. The price of the share is 88. The earnings per share is $11. Now, in the real world, they don't use the current earnings, they use the future earnings, but that's beyond the scope of this session tonight. So we would say that ProofRock sells 8 times its earning, or we might say that ProofRock shares has a carry or a multiple of 8. So every shareholder is earning $11 per share, and the price is 88. It means the shareholders are paying 8 times the earnings, because if they're earning 8 and they're willing to pay 8 times the earning for the company, so the price per share is 8 times its earning. And this is how we price a stock. Now, is 8 times too high, too low? Well, let's talk about historically how it works. PE ratio varies substantially across companies. But in 2014, a typical large US company had a PE ratio between 15 and 20. So the normal range for PE ratio, the normal range historically is 12 to 30, but in 2014 was 15 to 20. This is on the high side by historical standard, but not, this is on the high side by historical standard, but not dramatically so. A low point for PE was 5 in 1974. So in 1974, investors were only paying 5 times the earnings. So in 1974, the same company, if they were earning $11, investors were willing to pay 5 times the earning. They were willing to pay $55. Okay, so this is what we mean by it was 5. For example, Japanese PE ratio has been much higher than those of their US counterpart. So Japanese companies, the investors are willing to pay a higher multiple for their earnings. Because PE ratio measures how much investors are willing to pay per dollar of current earning, higher PE are often taken to mean that the firm has significant prospect for future growth. So the higher PE, the higher growth, or the higher prospect of the company, or at least that's what the investors are saying. Of course, if a firm had no or almost no earning, its PE would probably be quite large. And to give you a large PE, let me show you a real example. Let me show you Netflix as an example to see how this works, just to kind of give you an example. For example, Netflix, if you look at NFLX as a company, Netflix, and we'll compare it to other companies. Netflix has a PE ratio of 330. That's way above any historical standard. Okay, because remember, what did we say the historical standard? I say 12 to 30. They say in the book in 2014, 15 to 20. So when someone buys Netflix, they are paying 330 times their earnings. Now, if somebody bought Apple computers, their PE ratio is only 16.45, which is way much better aligned historically. If somebody buys Google is 29.53, which is on the high end. Now, the higher the PE ratio, the higher the prospect for a company, or that's what the investors think, because the higher the PE ratio, the higher they are paying for the stock. Okay, so always care is needed in interpreting this ratio. Okay. Let's finish the PE ratio, then we'll look at the price to sales ratio. Sometimes analysts divide PE ratio by expected future earnings. As I told you, what you do is you take the price divided by EPS, the future EPS, which is the estimated EPS. Okay? So the result is PEG, which is suppose proof ROC anticipated growth and EPS at 6%. What we called it's, let's see, sometime analysts divide PE ratio by the expected future earning growth rate. Okay, after multiplying the growth by 100%, this represents the PEG ratio. Suppose proof ROC anticipated growth rate of 6%, its PEG ratio will be 8 divided by 6, or 1.33. The idea behind the PEG ratio is whether a PE ratio is high or low depending on the expected future growth. So high PEG, price earning growth ratio, suggests that the PE is too high relative to the growth, and vice versa. So the higher the PE growth, the higher is the prospect for a company. Another market ratio is price to sales ratio. And this is basically taking the price of the stock, dividing it by sales. It's, in some cases, companies will have a negative earning for expected periods. So the PE ratio are not meaningful. So if the company is incurring losses, forget about the PE ratio, because the PE is price over earning. A good example is a recent startup. Such companies usually do have some revenues, but they don't have any profit. So what do we use instead? We use the price sales ratio. Okay, the price to sales ratio. The price per share divided by the sales per share. So in proof ROC case, sales is 2.3 billion. So here's the price to the sales ratio. The price is $88 per share, and the sales per ratio, 2.3 divided by 33, which is 88 divided by 70, or 1.26. As PE ratio, whether a particular price sales ratio is high or low, depending on the industry that's involved. Obviously, you want to have as much sales as possible. It's better off you are. But again, depending on the industry. Another ratio that we're going to be ending with is market to book value ratio. A third commonly ratio is market per share, market value per share, which is $88, divided by the book value per share. Now, how do you find the book value per share? Because this is another formula. Notice that the book value per share is equity, so we'll take equity, total equity, dividing it by number of shares. Again, and this formula is a shortcut. In the real world, it's a little bit more complicated. So we'll take market value per share divided by the book equity per share. It's 1.2. Okay, it means the stock price is valued 1.2 above the book value. Okay, a value less than 1 could mean that the firm has not been successful overall in creating value. Obviously, you want this number to be higher. Historically, this number is maybe 5 times, 6 times. So the market price per share is usually 5 or 6 times the ratio. Let me see what company do I have open this way. I can show you. For example, Google, the price is $8.23. The market value, $8.23. The book value per share, let me see if I can find the book value. The book value per share is 201. So if we take 800, which is the price of the stock today, 800 and plus, divided by 200, it's 4 times. Usually, again, depending on the industry, but usually the stock, generally speaking, they sell at 4 or 4 times their book value. Because this is how you create value for the shareholders. You generate profit, and the higher the profit, the better off you are. So market to book ratio in recent years appear high relative to past value. For example, for the 30 blue chip companies that make up the widely followed Dow, the historical norm is about 1.7. However, the market to book ratio in this group has been recently twice the size. And let's look at Disney. Disney is one of those companies. Let's see what Disney is. I believe that's pretty low. I was saying 4 or 5 times. Let's look at Disney. I mean, we can look them all up, but you can do it on your own if you're interested. So Disney is 110. That's their price. Let's look at their book value. Where's the book value per share? Book value per share is 27, so 100, so approximately 4 times. Let me take a look at another company. Obviously, Apple is a Dow, but let's look at GE. GE, I believe, is part of the Dow. GE has a price of 30. price of 30, let's say 30 just for simplicity. Let's look at their book value. Let's look at their book value. Their book value is 8. So 30 divided by 8, just rounding, 30 divided by 8 is 3.75. It's, I think it's more toward 3 or 4, but I don't know. You can look them up and find your own average if you'd like. That'll be an interesting thing to do. Another ratio called the Tobin-Q ratio. It's more like the market to book ratio. It's the market value of the firm asset divided by the replacement cost of the firm asset. So basically, you can just take those figures and divide them by each other. But to a great degree, what I did in this session, I covered most of the ratios. Now the rest, the enterprise ratio, you could basically, you can look at the formula, and it's basically the same thing. Total market value of the stock plus the book value of all liabilities minus cash to find what's the enterprise value. So you could just basically look at the ratios and interpret it. But the important ones, the main one I went over. So in conclusion, this completes our definition of some of the common ratios. We could tell you about more of them, but these are enough for now. Of course, there's many, but those are the ratios that we covered. In the next topic, so the next topic is the next session, we're going to be looking at, I believe, more ratios, but it's going to be a little bit different. Let me just take a look at what's next. In the next topic, we look at the Dupont Identity. And the Dupont Identity, it's basically a ratio, so it's going to be part of the ratios that we just work with. So before you look at the Dupont Identity, make sure you understand those ratios, because we're going to go back and review return on assets, some turnover ratios. But that's all what I'm going to go over in this session. If you have any questions, any comments, by all means, email me or see me in class. Make sure to complete your homework. It's a lot of work. Get started.